Hello and welcome to the World Built Environment Forum webinar series. My name is Simon Rubinson and I'm the Chief Economist at RICS. At today's webinar, we'll be focusing on the outlook for commercial real estate. And before going any further, what I would like to do is introduce an excellent panel going to help me navigate this issue. I'm going to ask each of them in turn to switch on their cameras and just say a few words about themselves, and then we will start the webinar conversation properly. So let me first introduce each of the panelists. Unfortunately, Kate Agnew's camera isn't working, so she's only going to be available on audio, but that's not going to lessen the contribution she makes in any way. Kate, can you just tell us a little bit about yourself, please?
Yes, good morning. Thank you, Simon, for hosting this. I'm pretty excited to hear from everyone else. I'm Kate Agnew. I'm Chief Appraiser of Natixis, which is part of BPCE in France, French Investment Bank. I'm here in the United States, and we have exciting things going on, as the survey will be telling us.
Great, thank you very much, Kate, and we're looking forward to hearing what you have to say and what you're seeing in the market at the moment. Simon Durkin, can you just tell us a little bit about yourself, please?
Yeah, thanks, Simon. Hi, I'm Simon Durkin. I'm the Global Head of Research, Strategy and Portfolio Analytics at BlackRock. Look, I'm equally, like Kate, really excited about where we are in the cycle currently and really excited to hear what the rest of the panel has to say and what the results of the latest survey has to tell us.
Thank you, Simon. The third panelist is Matthew Green. So Matthew, welcome and good afternoon. And could you just let us know a little bit about your background and your experience?
Yes, good afternoon, everyone. My name is Matthew Green. I head up the research team for MENA at CBRE. I've been based in Dubai since 2007 and probably will have a slightly different view potentially on where commercial real estate has been and is going to some of the other panelists, I think.
Thank you very much. We look forward to your contribution. Helga Scheunemann, you're back in Europe, so we're jumping around a bit, but welcome, good afternoon, and can you just say a few words, please?
Yeah, thank you, Simon. Thanks for the invitation to this panel. Yeah, I'm Helga Scheunemann. I'm the head of JLL, the German research team. And I'm with JLL, or formerly Jones Lang Whitton, for 30 years now. So a very boring CV, but not boring depending on different jobs and tasks I have to do, because, as you know, the environment changed every year. And so still interesting times and looking forward to this discussion.
Thank you, Helga, and yes, certainly looking forward to hearing your thoughts as well. My final panelist is one of my colleagues who oversees the market surveys at RICS. So I'll just ask Tarrant Parsons to say a few words about your experience.
Yeah, thanks, Simon. Yeah, I'm head of market analytics at RCS. As you say, I'm responsible for overseeing and producing the range of market surveys that we put out as an organisation. So these covering trends in residential, construction, and what's most relevant for this session, commercial property markets.
Okay, thank you, Tarrant, and we'll come back to you very shortly. So I just want to let you know before we do indeed go back to Tarrant that we have over 500 registrations today. So I think that's a pretty good uptake and shows the interest there is around commercial real estate at the moment, and that's from over 50 countries. I really want this session to be as interactive as possible. I know I always say that, those of you who have dialed into webinars I'm involved in before, but we really do want you to put your questions, give us your thoughts. We've got a wide ranging group of panelists covering much of the globe here, so there's a real opportunity for a good conversation, hopefully. Now, before starting that conversation, we thought it'd be useful just for Tarrant to give us a quick heads up on what the last commercial property survey results looked like. And just to be clear, this is a sentiment survey of RICS members around the world. Usually we get something in the region of 2,500 responses. So it's a pretty good uptake as surveys go. It's conducted on a quarterly basis. So over to Tarrant then, perhaps just to run through some of the headline numbers from the last survey, give us a feel of where the market might be going, or what it is and where it might be going.
Yeah, thanks, Simon. Yeah, I'll just take a few minutes to highlight some of the more kind of notable aspects of the latest global commercial property monitor results. I think, of course, in general, the financial backdrop does remain quite difficult. There's been quite a sharp rise in bond yields seen throughout the back end of 2024 and at the start of this year, triggered in large part by some disappointing progress in bringing down inflation in the US. And so that certainly is an added headwind for the market outlook. But I think despite all of this, there are still some small signs of improvement that can be taken from the most recent results. So on this first chart, if we just start by looking at the stage of the property cycle, our respondents feel their local market is currently kind of experiencing. I think this is quite a good indicator to summarize the mood at present. The purple bars represent the share of survey participants across each world region that feel conditions at this point in time are consistent with a downturn. And you can see the only region where this view is the most common answer choice is in Asia Pacific. So around 50% of respondents in that region are citing that their market is in a downturn. I'll go into some of the details around how this might stack up at a country level in just a moment. But overall, feedback across Asia Pacific in aggregate is more cautious than elsewhere at the moment. Now, the orange bars represent the proportion of contributors sensing the market has now kind of reached a floor or is sitting at the bottom. And this is just about the most prevalent view across Europe as a whole. In fairness, opinions are particularly mixed in Europe. As you can see, you have an almost equal share of respondents that do now view the market as having entered the early stages of an upturn. That's kind of depicted by the green bar. So I would say Europe is probably the most divided when it comes to this question. However, across both the Americas and looking at the Middle East and Africa as well, the largest share of respondents by quite a clear margin now feel the commercial real estate market is in an upturn phase of the cycle. For parts of the Middle East, this has been the majority assessment for at least the past couple of years. But across the Americas, I would say this view became much more widespread through the back end of 2024. So if we move on now to focus on some of the country level trends that are driving these perceptions, displayed here is our indicator tracking investment inquiries. So this is captured in a net balance format. So any positive reading there means that on balance, there are more respondents within that nation that are reporting an increase in investor demand over the course. And obviously a negative reading means an overall decline is being cited. I think to begin with, the United States is definitely worth mentioning here as our investment demand metric in Q4 registered the strongest reading that we've seen there for a couple of years. So it does appear as if a recovery is gaining traction. It isn't where we're seeing the most elevated reading still, but relative to where this indicator sat a few quarters ago, there is a notable improvement in the United States. Other markets over on the left-hand side there, displaying kind of the most robust momentum on a kind of global comparison. They include Saudi Arabia and the UAE, really solid demand conditions still being reported in both cases. I would say India also stands out as returning some strong results in contrast to the wider regional picture. And then on the weaker end of the scale and weighing heavily on the Asia Pacific averages, feedback across China remains especially downbeat. No real improvement to report as yet in response to some of the stimulus measures announced by the government. Elsewhere, I would say France as well, quite a lot of negativity is evident, very likely associated with political uncertainty following the vote of no confidence against the Prime Minister in early December. I think that really seems to have affected sentiment. And then alongside this, quite a few other European markets also show at least a somewhat underwhelming picture for investment demand. I think Germany, maybe the UK could be included in that. I think consistent with the view that the market is still towards the bottom phase of the cycle, or maybe just starting to turn in a more favourable direction, but still quite difficult. Then, by way of contrast, across southern Europe, you have Portugal, Spain, and even Italy, where there are now signs that investor demand is strengthening. So there are some more positive stories that can be pulled out across the continent. If we move on now and we kind of zoom back out to the global level and look at the picture coming through across some of the mainstream sectors, I think one of the more noteworthy developments of late is that following a very lengthy period of adjustment, trends across the retail sector have shown a bit more promise of late. And in fact, the last two quarterly readings for the investment inquiries metric across the retail sector, that red line, without wanting to get kind of too carried away, these have been the most positive across our results in about 7 years, so going back to early 2018. As I say, this is following a very difficult period for the sector, but there does seem to be something of a turnaround emerging now. And then on the other hand, the industrial sector over the past decade or so has seen very strong demand growth, but more recently, this has lost some momentum. It's still generally solid. But what is interesting is that the large discrepancy between the three traditional sectors, you can see there's a huge chasm between these lines in late 2020, early 2021, that has closed quite significantly over the recent past. Obviously, for offices, again, we've seen a massive adjustment following the pandemic, but now, at least at the global level, the investment demand series from the survey has recovered quite noticeably from the deeply negative readings that were seen over much of 2023 and early last year. So I'll just move on to the final slide for you here. And I would say that, having said all of that, you see that actually once you drill a bit deeper into this, it is clear that there's still a stark divide between the demand backdrop for best-in-class prime assets, which are really at the forefront in driving this improving headline narrative, and then in contrast, secondary markets, generally speaking, continue to struggle. So this is evident when looking at the capital value projections for the year ahead. These have been submitted by our respondents, and you can see that for prime office, industrial and retail properties in aggregate, these are all expected to see some uplift in capital values over the coming 12 months. But meanwhile, across secondary markets, survey participants, they do remain quite downbeat, returning outright at negative projections, as you can see from the chart there. Now, the gap between the prime and secondary projections there is widest across the office sector. So in fact, sentiment towards the outlook for secondary office values is negative across about 80% of the countries that are included in our sample, whereas it's positive for prime office values in about 3/4 of the markets we cover. So a huge divide, really. And so an adjustment continues to take place across secondary or older stock at this stage, where tenant demand remains much weaker and vacancies much higher in comparison to prime, and those kind of poor underlying occupier fundamentals are unappealing for investors and leading to kind of further downward pressure on values in some instances. So overall, it is a mixed bag. Certain aspects of the results have shown improvement, at least slightly. Of course, there remain many headwinds, and arguably these may be intensifying again given recent moves in bond markets. But in many cases, buyer demand for commercial real estate has picked up at least somewhat over the past year, and provided we get a little bit of luck with the external kind of macro environment and monetary policy loosening can continue this year, hopefully this gradual improvement at the headline level will be sustained going forward, even if there are still pockets of really challenging conditions across certain areas of the market. So that's my broad summary of the latest results. Back to you, Simon.
Great, thank you very much for that, Tarrant. And I think there's some real food for thought, and it will certainly, I'm sure, some of those charts will provide the basis around the conversation that we're going to have over the next sort of 45 minutes or so. If I could ask everyone to switch their cameras back on, and obviously, Kate, obviously, apologies, obviously, that we can't get your one up running. But look, I mean, if I just look at those numbers there, I think I'm going to have to start with Matthew, because the story there seems so positive, and I know that being involved in this survey, clearly we've seen, these numbers have been, really in positive territory for quite a while. So, I mean, what's the mood? I mean, is it, are you seeing the same sort of thing as, our results show? And can you really see it continuing? It's clearly been running for a while now.
Yeah, look, I think we're at very kind of different ends of the spectrum from a commercial perspective, and that's really been the same for the last 3-4 years. Post COVID, we've seen the commercial market kind of see pretty kind of solid increases in occupancy rates. We've seen prime rents probably increase by about 50% over the last kind of four and a bit years. Tenant demand from international and domestic occupiers has increased significantly. We've seen both major kind of financial centres in the UAE reach close to capacity within their office portfolios, ADGM and DAFC. We've seen a big influx of hedge funds, investment banks and other global financial institutions into the market. And it's really been a pretty significant sea change, I think, in terms of how international markets view UAE, view Dubai, view Abu Dhabi, view Saudi Arabia. So, I mean, it's not, I don't think it's, whilst the UAE has probably received a lot of the kind of headlines in terms of the turnaround in the real estate market, it's a very similar story in the commercial office sector in Riyadh at this point as well, with occupancy rates of quality assets at around about 98%. So, yeah, it's it's difficult to draw too many kind of comparisons against the commercial markets as it's been in the US and Europe over the past 3 years.
Yeah, perhaps it's been less. Well, I suppose the economics has been was being clearly very different, but it's not been impacted in the same way by perhaps global economics as most other
And
markets.
yeah, and exactly. Look, I mean, the interest rates have a much lesser impact here. We've also had incredibly strong non-oil activity, again, across Saudi Arabia, across UAE during that period as well. So you've had very strong government support. There's been significant increases in spending, so expansionary budgets from the government, massive investment program, obviously, that everyone would know about in terms of Saudi Arabia through PIF and its entities there. So I think there's been a driving force from the government, but then also I think just the kind of the speed which the economy's turned around post COVID, the structural changes that the government made in terms of visas, company ownership, all of these things really just kind of came together at a time when other markets were kind of losing their appeal. The UAE
Yeah.
and the region generally, I think, has just seen heightened appeal to corporate occupiers.
Okay, thank you. I mean, Kate, Tarrant mentioned the United States, and I have to say that when we're not discussing construction today, but I am aware that the RICS Construction Monitor also showed very positive results for the US. So something seems to be, emerging, a slightly better mood, you know, albeit sentiment in both those surveys that RICS run. So I mean, how do you sense what's going on? And clearly, there may well be a political dimension to all of this. But what's your sense?
It's interesting because both of those monitors showing the sentiment increasing, I think, is encouraging, but the results are yet to be seen. For instance, the office market dropped 11% year over year at the end of 2024. But the belief is, and the hope is as well, that that is the bottom. Most of the economists here and the prognosticators are saying that we're looking at a bottoming out. While that really applies to our Class A office market, we got a little ways down to go on the B and C. Mostly what I think is happening in the US market is that there is a coming to terms with this is how things are. Buyers have been holding out until the sellers drop their prices. The sellers are saying, I'm not going to do that. Otherwise, I'm going to take a loss. So the buyers are capitulating and beginning to buy at that. And I think that that's a hopeful sign for us in the market here. I'm also watching very carefully the fact that there's no correlation right now between the interest rates and the interest in the market for properties. It's just interesting to me because the conventional wisdom has always been if the treasuries begin to drop, we're going to see the reflection in the cap rates. That's not happening. So as we move into 2025, there's certainly uncertainty that's been introduced by the political climate. Not going to go any further into that, but I think what we're seeing now is pausing, taking a breath, and making decisions about where to go. I think another really positive sign is that from 2022 to 2024, construction in all the four major food groups has dropped off, and that helps the supply side of the equation. I'm looking forward to seeing 2025 unfold and see how what we just talked about here in the sentiment from the fourth quarter play out in the US.
Yeah, that's interesting. I mean, we may come back to some of the sort of geopolitical issues in a bit, but I'm struck by the fact that most, and others may want to come back to me on this, but when I look at some of the sort of the macro forecast for the US, despite some of the unsettling sort of discussions around tariffs and the impact on free trade. Overall, I'm seeing the numbers not change very much, and maybe that's because of belief that perhaps some of the focus on deregulation will provide a sort of a compensating boost for any negativity that is driven through perhaps a more protectionist trade stance. I think what I'll do now, we'll turn to Europe, and then I'm going to get Simon with your more global remit to sum up what you're seeing. So, Helga, obviously you're focusing very much on Germany. The numbers on Germany, our numbers have been, not been particularly upbeat. There's been lots of issues about German real estate. We've obviously had the political dimension as well with the election at the weekend. So how are you seeing things at the moment in the German property market?
Yeah, I mean, honestly, there would be a lot of things to cover, and but I can echo what also Kate said, that the interest rates or the ECB rates are not so much in the focus for investors as you may expect, because everyone said, okay, we now have the new normal of interest rates environment, and we will never come back to the zero rate environment. And I think that's also good. And everyone has to live with this new interest rates environment. I think the main issue is that on the one hand, the sentiment and the confidence in the property market is rising again. And we also did a lot of sentiment surveys, and also for institutional investors, they will come back to the property market. There's a lot of liquidity waiting on the sidelines and waiting to invest. And they are waiting for opportunities. And if you look to the cycle now, and also to the historical cycles we have in the last 20 or 30 years, then you have to look very in detail, and you can see that this cycle is still over, because the turning point has reached in the last quarter. Q4 or Q3 24, their capital values has reached its bottom, and now I think it's the best time to invest again in the market. If you have fresh capital, if you have the enough equity and get a finance from banks or financial institutes, then I think the market in Germany offers some good opportunity to jump in. I mean, this is a clear. And I think we all need to be very clear that we need to differentiate between the asset classes. And also Tarrant mentioned industrial and retail. Retail has a strong comeback also in Germany, inner city, high street properties, but also shopping centers are on the list again. I mean, the problematic thing is about offices, and nobody knows who should buy all the offices that we have in the market. I mean, we have a strong increase in industrial investment, logistics, living sector is booming, still 25, but the main problem is offices.
Okay, well, look, thank you for that. I've got some, and I will come back with some more general macro sort of points in a while. But let me now turn to Simon. And I mean, obviously, you've got a global perspective, but I would also particularly like to hear what you've got to say about the UK, because I'm sure a lot of the people who have dialed in are based in the UK. And I'm also interested because France was pointed out by Tarrant as being a weak performer. I mean, I'm not sure everything I've read about Paris is quite so downbeat. So I'd also quite like to get your view on that, if possible.
Yeah, Simon, absolutely. Let me start with a few comments on the UK first. As we've seen in every cycle, the UK is normally the fastest market to reprice, and this cycle has been no different. So we first started seeing valuation declines sort of Q1 2022, and we saw the majority of the valuation adjustment take place, which is phenomenally quick. Clearly, the office market continues to fall and is just sort of starting to stabilize now because uncertainty still around offices, and I'm sure we'll move on to that later. Industrial, given that yields were more tightly wound than anywhere else. And to Helga's point about retail has proven relatively robust at that blended average level. Residential performed pretty strongly. It did the job that it's expected to do in a portfolio. It did resilience. Now, whether it provides the relevant amount of performance in an upswing, given it's already provided resilience during the downturn, is questionable, I guess. Now, what I think is really important here is that we don't fixate ourselves too much on these market averages and the index figures. Full interesting, but tell us what a market average has done. Now, there is huge dispersion at the asset level and even the market level around these market averages, and that's certainly what we've seen. So whereas the index might tell you that peak to trough values have fallen by 27% in the UK, the around that figure is absolutely immense. So we're seeing increased dispersion at the asset level and at the sector and at the regional level that we probably haven't seen in previous cycles. We certainly didn't see it coming out of the GFC, when the low interest rate environment pretty much turbocharged valuations for everything. Whereas now we refer to this environment more as that K-shaped recovery, and ensuring that we're on the upward trajectory is going to require alignment with what we're referring to as the mega. So aligning your cyclical investment strategy with demographics, with deglobalization, with net zero transition, but also geopolitical fragmentation, which is only going to increase. I'm sure we'll touch on that again later. So huge dispersion, which I think requires a different way of thinking about market and opportunities. The second part of your question, Simon, related to France. Is that right?
That's right.
Yeah, absolutely right. I mean, within Paris, Paris CBD offices, Paris CBD retail. I mean, if you wanted to play in that market, you would, frankly, see very little actually in values, because there's not a lot traded, because it's such a tight market in high demand. The rest of France, yes, there's a geopolitical context for France, but I think there's a geopolitical context impacting every market. The biggest problem I think real estate faces, even though I firmly believe whatever has cited in terms of being there or thereabouts at the bottom of the cycle, I think a strong bond market is not helping real estate, and I think continued strength in the public markets is also not necessarily helping real estate as an asset class. But if you think about the overall dynamics that we face now, we have volumes starting to increase. We have interest rates coming down, okay, not as quickly as we would have forecast this time last year, but interest rates are on downwards trajectory. We're seeing a little bit of inflation. It's not necessarily a bad thing for real estate. So we're actually seeing a lot of the early indicators of an improvement in the market. To that, we've also seen a circa 25% decline in values.
Okay, well, look, thank you very much for that. Tarrant, actually, just very quickly, we've got a question that came in, and I just wondered whether you could just give us a very quick response to it. So, in that last, and this is obviously just jumping around a bit, and I'm going to come back to the bigger picture shortly, but in that last slide that you produced, you showed the discrepancy in expectations of respondents to the survey between prime and secondary. And I think that one of the questions that came in, the question that did come in was really about whether or not it's taking account of secondary purchases of real estate for change of use. So how does change of use work in this?
I'm not sure it's going to be fully reflected, given the question isn't specifically mentioning that it's purely what do you expect to happen to valuations in these markets. So I'm not sure that is really accounted for in our numbers.
Okay, though we do sometimes ask specific questions about change of use, don't we?
Yeah.
Okay. All right. Thank you. Look, I mean, Simon just mentioned a bit about sort of inflation. A little bit of inflation is no bad thing. And I know that we were going to sort of look at a bit about sort of headwinds and tailwinds for the commercial property market. Simon sort of started that conversation. I suppose if I was just being a bit more cautious, I might say if I look at, the risk of perhaps tariffs, protectionism, impact on free trade. What do tariffs do to inflation? Big deficits everywhere, big government deficits everywhere. One could be, a little bit more concerned about the inflation outlook than, perhaps has been expressed. And one might take the view that, and I have seen the odd, not many, but I've seen the odd forecasters sort of suggesting that, perhaps interest rates not just won't come down, but, could they go up even? Are we being a little bit complacent? And if that was the case, even though we've seen this adjustment in values on real estate, how well protected would the sector be? So, I mean, I don't know. I mean, Kate, do you have any thoughts? I mean, from your perspective about sort of the cost of money and the risks associated with perhaps an inflation surprise on the upside?
An inflation surprise on the upside would quell new lending that was going on. We've recently just come to terms with how the market is, as I mentioned before. An inflationary surprise could throw a wrench into that, or a bucket of sand into the mechanisms on this. I think from the lending perspective, and I want to be clear here that I'm speaking as a fellow of RICS and not a representative of Natixis, that we are working with our borrowers and our potential borrowers to structure deals such that we aren't in a position of inflation shock. We've moved to SOFR, did that a couple of years ago, and that's helping to stabilize what's going on. We're also looking at insurance instruments to ensure that both we and our borrowers are protected against that. We could probably handle, and the market can probably handle, a little bit of a shock there. How much, I don't know. I am concerned long-term about the results of the tariffs and how that would work in with inflation. However, I have noticed that over the past 6-8 weeks, as tariffs are announced, there's some behind-the-scenes negotiations that they're announced and then they're lifted. I think this is going to be a pattern that we see over the course of 2025, and I'm pleased to see that there is not an immediate shock where someone switches a toggle and says, "Oh no, we have tariffs against Canada," and an immediate spike. And I think, in spite of the fact that it's a bit of a roller coaster right now, the markets themselves are not flinching when it comes to real estate.
Okay, thank you. Thank you for that. I mean, Helga, what about you're in Germany? I mean, obviously interest rates, the ECB interest rates are lower, but this does partly reflect sort of economic performance and inflation. We've heard the new chancellor, I should say, in Germany talking about lifting the debt brake. Perhaps a bit of inflation is no bad thing, as Simon's already said. But how do you see that sort of risk there, and could the bond market still be a challenge for a real estate recovery?
Yeah, I mean, in Germany, inflation is historically a hot topic, and everybody is looking very carefully on inflation numbers. My view is that for now, that we don't have a risk in inflation upside potential. I mean, we still have some wage growths, and we have these tariffs discussion. Tariff is the word of the year for my thing. It's still clear, and this will, the discussion will follow us during the rest of the year. But I think we see with the new election and the new government in place, and also the discussion of a debt brake reform. I mean, this has two angles. I mean, on the one side, this should push the economy and should give a push in necessary investments in infrastructure and all these kind of things. On the other hand, it could raise also inflation. So this is a little bit of tricky thing. And the ECB is in a very difficult situation because the European zone is so different in relation to the economic environments, economic developments. And so that's not an easy job. And I think it will be very carefully looking at the interest rates discussion, and also the rhetoric of the ECB in the coming weeks and months. And but to summarize, I don't see from now any significant increase in inflation. And if so, I mean, it's not so bad for real estate, as most of the occupier contract and lease contracts are inflation adjusted, and so I think that's not overall a bad thing.
Okay, thank you for that. And I just want to remind everybody who's dialed in, please, we do welcome your questions. So please put them in the question box, and we will get to them as soon as possible. Just going back to Simon, I mean, from your perspective, in terms of sort of headwinds, I mean, you alluded to some, but I get the look. I can understand why most panelists are pretty constructive about the outlook. I mean, what sort of headwinds? We'll get on to opportunities in a minute, but are there things that you're looking at which worry you, which make you think, well, I mean, I'm not going to sleep easily tonight on this one?
I'm a researcher, Simon. Lots of things worry me, irrespective of where we are on the cycle. Um, I think the macroeconomic indicators I'm relatively comfortable with at the moment. The biggest risk and the biggest uncertainty is around sort of geopolitics and uncertainty that's driven by this very uncertain environment that we live in, and the impact on investors, on investor sentiment into the asset class. But in looking back over the last 2.5 years, I take some comfort, I think, for real estate, because if somebody had said to us in 2022 that interest rates were going to increase from less than 1% to over 5%, and inflation was going to hit double digits, I think we'd have all expected the real economy to have pretty much imploded. Um,
Mm,
and we didn't see that. We didn't see unemployment spike significantly. We didn't see widespread business failure. Um, yes, we saw a yield-driven valuation adjustment, which we would expect to happen, but we didn't see an imploding economy. And it always takes a good downturn to focus investors back on the fundamental drivers of real estate, and that's ultimately income. So I take some comfort, I think, in the resilience of the occupational market, because I'm not expecting to see shocks anywhere close to the ones that we've lived through over the last 2.5 years in the post-COVID environment.
okay, thank you, Matthew. I mean, I mean, do you see sort of the sort of markets that you cover as being almost like a hedge against all of this sort of turmoil that sort of potentially could still um, uh, provide a bit of a headwind to some of the other markets, despite the fact that they are now looking better value?
Yeah, look, I think traditionally the UAE and the region has tended to do quite well out of geopolitical challenges elsewhere. I don't think that's been any different, particularly over the last kind of 3-4 years, whether that be Russia, Ukraine, or more recently within the kind of Middle East. Most of this is really just ended up funneling additional capital, particularly into residential markets, say like Dubai, where we've seen a massive increase in transactional activity from kind of pre and kind of post COVID. And I think, look, that is likely to continue. I mean, look, we are exposed obviously on the trade side. So obviously any major kind of impact from tariffs on kind of global trade volumes wouldn't be particularly good for the region, for the non-oil sector. But I think what we're really seeing more and more at the moment is, given challenges elsewhere, we're starting to see a lot more institutional money that wants to be here, and again, a lot more serious than probably ever I've kind of experienced in all my time in the region. That's global sovereign wealth funds, private institutional capital, again, all coming with very kind of similar mandates, wanting to obviously get into the institutional market, maybe seeing that there's limited kind of liquidity in that market and looking to kind of maybe go more down a kind of development route or a kind of a mix of the two. So yeah, at the moment we're just seeing the kind of the positives of those challenges elsewhere. Some of that's coming from China kind of uncertainty. Some of it is coming from changes to kind of taxation in Europe and other kind of jurisdictions. But yeah, generally all just a net positive for the market here.
And is the
Most of that
pipeline
is
quite strong? Is the
no
pipeline of
from
new supply strong?
No, and that's, look, this is probably one of our biggest challenges. And again, it's probably not one that maybe many other markets are facing in the same way. And look, a lot of that is been due to the strength of the residential market. And it's been a real kind of fight for capital, I suppose, over the last kind of 3-4 years, and a lot of that capital has been allocated towards residential off-plan projects. They've been very, very successful. So I think obviously the kind of competition to be able to develop commercial or I&L assets is being kind of so strong that the pipeline of those of asset classes has really kind of lagged behind. And then we've had such strong demand, whether that be for retail, I&L, or commercial, over the last 3-4 years. And I'd say all of those sectors are now facing an undersupply, and really the next couple of years pipeline is just not going to be efficient. So that's really resulting in occupiers more and more staying put where they are, looking at renovation of existing accommodation, because you don't want to be going out into the market at the moment trying to look for a new accommodation. Landlords becoming be very, very aggressive in terms of their terms, and just frankly there isn't a huge amount of good quality product available for lease across any of those asset classes.
Okay, thank you. I will come back to the big picture because we got a question in a bit. I just wanted to touch on the offices. Taryn, you were talking about the gap in expectations between prime and secondary, and we had this question that came in before about change of use. I mean, are we seeing in the survey any sense that the soft numbers that are coming in on secondary offices in some countries, is that beginning to stabilize in any area, in any parts of the world, or is it still looking at all the country numbers, is it still a pretty negative story?
It's still quite negative, but it's not as downbeat as it was maybe 12 months ago. So that's how I would describe it.
Okay, thank you. Well, look, Simon, I mean, from your perspective, as in looking at a global sense, do you get any feel for sort of a shift in mood around secondary offices? Are we getting more that are being um, uh, converted into, whether it is residential or other sort of product? What's going on there? And is there light at the end of a tunnel, or have you still got a long way to go?
Well, for secondary offices specifically, if there is light at the end of the tunnel, it's probably still fairly dim. And I think back to my earlier point about understanding the actual ranges around the averages that we talk about, because I think secondary offices will continue to be uh, I think for some time. I mean, if we look at the locations where occupiers have successfully brought people back to the offices, these are offices that are located in very dynamic, vibrant sub-market locations where people actually want to be. And if people are coming back to the office for 3 or 4 days a week, they actually want to be in places where they have got that vibrancy. I mean, otherwise, I think it does put a big question mark back over the actual benefit of traveling into an office. And I think you will continue to see employees pushing back against some of these locations. Although having said that, we own an asset in Birmingham, an out of town asset performing incredibly well, and occupationally, clearly during COVID, occupational visits dipped significantly, but they bounced back very, very quickly. So I think the answer is really nuanced. I think it really does come down to asset specifics and
Mm,
sub-market location specifics, and I think it's almost impossible to just paint the entire sector or even a subsector sectors just with a broad brush. I think in terms of where the market might be in the US, I think valuations have still got some way to go in the US. I mean, if you look at what little has happened in the transaction market versus where appraisals currently sit, it's fair to assume that that office market has still got some way to go in terms of value
mm,
adjustments. But yeah, I mean, return to office. I mean, if you go, those of you who are in the UK, if you go to the city on a Monday or Friday, yes, it's really quiet.
yeah.
If you're in the city, if you're on a Monday or a Friday, it's incredibly vibrant. And guess what? People are more likely to come back to the office in those locations because they're places where people actually want to be.
Yeah. I mean, there is a comment from one of the delegates saying that there is there is a strong demand to repurpose secondary offices to hotels, and I hadn't mentioned hotels, but
Yeah.
that's certainly an interesting point. Kate, from a financial point of view, I mean, I mean, is there funding to to support repurposing of secondary offices, and to what extent is distress still seen as an area of concern for bankers when they're looking at offices?
Well, I'll answer the second question first because it's a little bit easier of a question. I think that there is still concern about distress in the office market, and it continues. What we're seeing is the same entities which have traditionally come to banks for funding are giving back keys or asking for restructuring on the other hand. So you have them coming seeking new funding at the same time that they're handing back. It's a phenomenon that I had not expected. Financing is there for properties that have certain leasing levels depending on their market. I found an interesting phenomenon that I was reading about the other day that that's an exaggeration, some office owners are looking to bifurcate the ownership of their properties so that they'll have a land lease in addition to owning the building, and then looking to separate it later on, the land having a lot of value in areas that are built. And that's not something I've seen before. I think that the first part of your question goes to, is there financing available? Seeing a lot of SASB, single asset, single borrower coming through. That gives a lot of banks that are participating comfort that they're lowering their risk profile at the same time that they're doing business. I think the CMBS market is definitely coming back. I've seen more transactions come across my desk. And when it comes to non-traditional assets that are being financed, I think it's interesting as they come into focus that they've become a bit more mainstream. And I'm particularly looking at asset classes that are in states that support affordable housing, but being able to transfer the affordable housing credits or requirements between properties. I think that addresses needs without compromising the strength of the assets that are there. I'm really interested and fascinating to watch how the market itself is adjusting to asset classes and their relative strengths and the interest that there is in what last year or the year before we could consider to be non-mainstream and how they're entering the mainstream. I think 2025 is going to be an amazing year in commercial real estate. No matter what happens in either way, we're going to be taking this as the benchmark of forward lessons in a way that no other year has had. One person's opinion.
No, that sounds really interesting, and we'd like to look back on that in perhaps next year and see whether this has provided that sort of benchmark to work from. Helga, I mean, in Germany, you talked about retail, I think, in your earlier comments, seeing a bit of recovery. I mean, could you just give us a flavour for what the mood is on sort of that dispersion between prime and secondary on both the retail and the office side? And are there some cities where the secondary side is a bit firmer, or is it sort of a fairly standard picture?
Yeah, sure. I think it's very important not to mix up secondary. I have a little bit difficulties with the definition of secondary because you can discuss about secondary location and you can discuss about secondary product. And I think that it's a big difference. And for us, it's a clear trend in the office sector, but also in retail, also logistic, founded by the behavior of the corporates. For example, in the office markets, almost 70% of all office users, they only rent top office space. But this top office space could be even in the CBD areas, in the inner city areas, but also in B locations. So the main point is here, the equipment, the quality of the fitting of the office building, also retail and what else, is more important than the location. And I think that's a very important thing. Also, when you do these kind of surveys, from my point of view, secondary is not secondary in one language. So And what we see here in Germany is that we also see some investors with sufficient capital, and they also discovering B locations or B products to upgrade them. And I think that that's a very necessary thing also in relation to achieve climate targets and the age and building stock we have. And this strategy is necessary for the whole country and for the whole real estate industry. Also to reposition locations and districts. And what is very clear from my side when it comes also to financing these kind of B products, and I think the monofunctional structures, these things, I think of the past. I think we have to think in multi-use properties, in multi-use districts. And the good thing is that we see this trend in Germany, that we have a lot of significantly rising increase in the share of renovations and refurbishments of older buildings in the next 2 years. So I think that that's a positive thing in the market. And and I think that that's important. You have to differentiate between when you talk about secondary.
Okay, thank you. Actually, I just wanted to go back to Simon very quickly. I mean, you talked about the different usage of office space. You cited London as an example, and when it's busy and when it's not busy. I mean, to what extent do you think that and I've heard some sort of discussion about this, to what extent are asset managers now thinking about, how AI might be a factor in the way that they actually use well, first of all, think about headcounts going forward and therefore use office space. Could that actually be a factor that actually weighs against this, not quite return to the office, but the demand for office over the sort of medium term?
Yes, yeah. I think the biggest potential disruptor to how buyers use office space is probably AI. I think how we integrate AI into our general workflow and into our business is potentially going to have a really disruptive impact on how we actually use space. And equally, that will impact the rate of recruitment that some businesses might feel is necessary in order to sustain growth. The relationship between organizational growth or business growth and headcount is probably a broken relationship now, and I think the businesses that are quick to adapt to AI and integrate it will probably have a better understanding far more quickly as to how they need space to work for them.
Okay, yeah, no, thank you. Look, I want to jump around a few quick questions. Matthew, we've got this question in from one of the attendees about what the outlook is for the African market and particularly South Africa. Could you give us a quick flavour on that?
I don't cover South Africa, so basically, I mean, from here we look after Middle East region, North Africa, but not South Africa. So
Okay, not South
I'll be
Africa.
covering.
Okay, Simon, you don't cover South Africa, do you?
No,
No?
we don't cover South Africa. The MSCI index for South Africa should be useful to the to the person who asked that question. You can always reach out to me and I can dig that.
Tarrant, what was the feedback on our last survey on South Africa?
Yeah, I think South Africa is one of the more interesting markets in terms of what we're seeing change there for a number of years. A lot of kind of pessimism, a lot of at best kind of stagnation. But the last couple of quarters, particularly in Q4, this does seem to have kind of changed. And if looking at through the anecdotal kind of comments that have been left, it's been attributed to rate cuts, policy interest rate cuts, but also a more positive change in the political backdrop as well. If you look across sectors, it is being driven by industrial, the kind of the most promising outlook there, but quite widespread in terms of investor demand growth now and also occupational demand. So yeah, a real kind of turnaround there, which I say had been struggling market, quite flat for a number of years, but the past quarter has seen a turnaround.
Okay, great. Thank you. And if the attendee wants some more details on that, you can always get in touch with
Yep.
you, and you can give them the full set of results for South Africa. So please do that. Um, right, quickly on. I noticed a headline, perhaps it was in the FT yesterday, or some, I think it was yesterday, about BP shifting their focus from green energy to more perhaps brown energy, going back to oil and the like. So I feel I want a quick word about sustainability. To what extent, is this changing narrative going to have any impact on the way that owners of properties and indeed, potentially tenants think about what prime is? We were used to be, and I think Helga, you talked about, the sort of the quality of the space and what it is and what constitutes a prime office. I mean, to what are we going to see a shift that, this is not as important for investors going forward, or will it remain very much the fore? Helga, since you started that, raised it first, could you give us a quick word on that? And I'll ask you all to be quite quick because we've only got about 4.5 minutes left on this.
Yeah, sure, sure. It's a topic for its own. But I think the business case for decarbonization and ESG remains strong, regardless of the political landscape. But what we're seeing is a shift in the language from ESG and sustainability more to value protection, creation, and de-risking assets, potentially with a more focus on innovation and tech, and also a shift in objectives away from reducing carbon emissions towards more adaptation and resilience. I think that's the key elements. And I mean, the fact is that we are in the midst of a dramatic change in climate. I think that that's true, regardless of what priorities are set where and by whom, or whether you believe on climate change is man-made or not. But I think the key element is that we have to deal with this climate change, also, and especially the property market, which is lagging behind other sectors. And I think the EU made the right decision to focus more on economy, because economy is the base. And if the economy is developing strong, then you can also develop the climate change and the environmental points.
Okay, thank you. I mean, look, Kate, again, just look, from a valuation perspective, how are you seeing? I mean, can you see the narrative changing and the way that that buildings are valued changing as a result of perhaps some of the shift in discussions around what the importance of sustainable features in buildings, how important they are? Obviously, I take on board Helga's point there, but what are your thoughts?
I'm going to go very quickly because I'm aware of time, but valuers have struggled with the issue of how to bake into their valuations the impact of sustainable, forward thinking, and seeing where it's going to go in the future. I think we're the easiest for valuers to address is the cost savings that are introduced by sustainability efforts. Things as simple as changing the light bulbs out, or as complicated as changing out the HVAC system to make it more efficient. That benefits landlords, that benefits tenants. And when you can do a cost benefit analysis that easily, I think it makes the case for sustainability without using the word sustainability. I'm very proud of Natixis being the first bank to sign on to the 1997 Paris Accords. I think that that's something that we will continue to place our efforts towards. And I think valuers are going to need some strong guidance of exactly how to address going forward what the sustainability aspects are for any real estate.
I mean, that's really interesting, and that, as I think Helga implied, I think that's a discussion for another webinar, really, because it's a really interesting area. Just then, quickly, Matthew, anything in terms of how sustainability is on the agenda in the markets you're looking at?
Again, obviously, in a region which is driven fundamentally by oil, the yes is very high up the agenda. And look, there are building codes at an emirate level, at a country level, which obviously drive the requirements for green buildings. So you're going to see a massive increase in the number of green buildings, which I think in the long term will also probably lead to significant investment flows as institutional investors obviously look for quality new assets. And we're certainly going to be developing those in quite significant volumes within the markets that we kind of cover here. So
Okay, thank you. Look, Simon, I'm going to give you the final word, but I actually would like a slightly different response here, a different question, actually. So, if you were looking forward, you've got a global hat on. Where's the best opportunity for people over the next sort of 2 to 3 years in terms of global real estate? What would you be recommending?
I would focus on cities. Cities will ultimately be drivers of growth. If we look at the differential drivers of European and country level performance, it's cities. So getting your cities right and less about specific sectors and more about society's need for real estate. And that will lead us more towards thinking about mixed use developments. It'll make us think more about how residential, for example, interacts with the workplace and with social infrastructure. So, yeah, very focus on the cities.
Okay, great. Look, I'd love to talk more about that sort of issue, and I don't know whether perhaps we've sort of we've run out of time, and that's unfortunate because there's a lot more to be considered here. So, look, can I first of all thank all of the panel and all the support staff, everybody that's helped put this together. Thank you very much for your contributions today. Um, I hope everybody who's dialed in has enjoyed the conversation. We've had some questions, and if there are any questions people were reluctant to ask, they can still put them into Tarrant and I, and we'll do our best to respond to them. We will be publishing a recording and a written summary of this webinar online. And when we've done that, obviously, we'd be very keen for you to share those with your professional networks. There is going to be a quick sort of poll at the end of this session, really just trying to gather your feelings about how the webinar went. We want to obviously know whether you felt it was worthwhile, what you would like more of, what you'd like less of. So please do contribute to that, because it's by your contributions that we're able to deliver sessions that are of greater value to you. We do have a number of webinars coming up over the coming months, and I think they're just coming on your screen now. There they are. So if you look at these and you like any of the sound of them, please do sign up. But you can always have another look and check out what is coming on rics.org/webf. And obviously, if I've said this before, but if you do require any further information, please, look at the website or search for World Built Environment Forum on LinkedIn, and there will be lots of details about stuff that we're doing.